Hello and welcome to ETF Pulse, ETF.com's podcast. I'm your host, Kristin Myers, editor-in-chief of ETF.com. Here as always with my co-host, Nate Geraci, president of the ETF store. Let's take a quick look at the Pulse rundown. So first up, Vanguard has actually filed for a new emerging market ETF, minus China, and it seems to be a part of a growing trend. So we'll chat that. And then could mid-caps start to get exciting? It is the big question because Nate said snore when we were talking about big caps earlier, but they have cracked the list for top inflows, and we want to see why. And if you want to invest like Warren Buffett, now you can. New funds from Vista Shares promises to invest in the top picks of some of the world's best investors. And last up, it would not be an ETF Pulse episode if we didn't have a crypto topic. We'll be talking about crypto staking and how it is causing a regulatory snag or headache for some new ETFs that are seeking final approval from the SEC. So, hello, Nate. Aren't you so excited? We're going to be chatting midcaps today. I am.
I'm already asleep. You need something more exciting to wake me up. Vanguard X China. I may have some.
Yes.
Some thoughts
Let's start there. So there's now 13 ETFs. Apparently, this is according to Morningstar data, that are now emerging market ETFs X China. I mean, it seems to be very well timed, this new Vanguard launch. It is a low fee, and we were chatting about low fees from Vanguard, I believe, in the last episode or the episode before. But it is a new low fee ETF from Vanguard that is investing in emerging markets. I mean, I think it makes a lot of sense what's happening in China, not just between the US and China in terms of trade, but in terms of China and its openness to foreign investment inside of their companies. I'm surprised actually there aren't more ETFs ex-China. Emerging markets are not just China and India. There's a lot of countries on that list that could make up that category. But you're smiling, and now I don't know what you're going to say.
So I think we did touch on this a couple of weeks ago, where since the Trump administration appears to be taking a much more aggressive posture towards China, which we obviously saw that on full display with the tariff situation, which we're not going to get back into this week. No tariff talk.
No tariff talk today.
I think some investors obviously want to avoid exposure there. And I get that, but I think I would disagree a little bit with what you're saying around the timing of this, because if you look at international stocks as a whole, they've outperformed this year.
Yes,
and
they have.
China stocks in particular are having an absolutely stellar year. So if you pull up the performance of an ETF like the iShares China Large Cap ETF, ticker FXI, or if you look at the Crane Shares CSI China Internet ETF KWEB, those are significantly outperforming. And so I wonder if investors might be looking to exclude China at the wrong time. I guess we'll see. All of that said, Kristin, I get it, because all of these negative headlines around China trade and Taiwan and China's government clamping down on companies, to your point, I do think that causes some investors to wonder whether they should, own China longer term. And so clearly you have an issuer like Vanguard trying to respond with some options. So I get that.
Well, no, I was going to say I pulled up FXI since you mentioned it. And just as a reminder, in case you don't remember what Nate said 2 seconds ago, the iShares Trust China Large Cap ETF. So looking at its performance year to date, up over 16%. So clearly beating broad market, because right now broad market isn't even up 1%. It's up just less than 1% year to date. As we've come back a little bit from some of the gains that we had originally made. And then the 1 year up over 35%, right? So I'm going to compare that to SPY right now. As I just mentioned, year to date, we're up about 1.5% in the broad market. In the 1 year, we're up about 14%. So obviously China handily beating, but then you look at a larger time horizon, right? And if you look at the 3 year, FXI is only up 5.5%. And in the 5 years, actually down 0.5%. And then if you want to compare that to SPY, we actually have SPY in the 3 year up over 14, and in the 5 up about 16. So, I mean,
well, it's even worse than that, because if you look at the volatility of China stocks, you're talking about a huge roller coaster ride.
Yeah, so, you said TLT was a widowmaker because of the roller coaster ride. I mean, if we look at FXI, I mean, you're really signing up for a doozy of a trip, honestly.
Yeah, I think what I'm saying is, everybody's been talking about when will international stocks sustain their outperformance, right? We've seen these periods over the past however many years where they'll pop up for a few months and then go away. I think there's a sentiment out there that maybe this recent outperformance is real and it might be here to stay. And if it is, then if you're investing in a ex-China ETF, you're making a bet to exclude the world's second largest economy. And that's actually what's noteworthy here too is, this is coming from Vanguard. Vanguard's very meticulous when it comes to new launches, right? Vanguard doesn't just throw stuff at the wall to see what sticks. And so to have a firm like Vanguard who preaches, buy and hold, own a well-diversified portfolio and let it work for you over time, for Vanguard to say, here you go, let's exclude the world's second largest economy, I think that's a pretty big statement.
I mean, there are some people that say, listen, Chinese stocks have actually mounted a sort of recovery, and this actually might not be the time to really sort of exclude China from your EM sort of ETF. But I mean, again, if you look at I think that's the existential question for some of these emerging markets. I think not just for international writ large, but particularly an emerging market. I can't tell you how many panels and conversations I have sat in on where people have continuously said, oh, like India is the next big thing. You got to get in now. It's going to explode. It's going to explode. I mean, you have an economy with 1 billion people that's incredibly young, tech savvy, et cetera, et cetera, et cetera. And it hasn't happened yet.
Yeah, but again, China's the second largest economy. So I'm not here to wave the China flag and say everybody should be piling in there. All I'm saying is that if you're a long-term diversified investor, it's a huge bet. Like if you look at the Vanguard FTSE Emerging Markets ETF, ticker VWO, last I checked, the weighting to China in that ETF is like 32%. So just to show you in a broader, for sure, yeah. But that's my point, is that in a broad emerging market ETF, here you have a 32% weighting. You can have that, or you can go to zero with an ex-China ETF. I'm just saying that you're making a bet in a portfolio. The other thing that I have to say here, just real quick, before we move on, and I think we've talked about this ETF before, I think we need to give credit to Perth Toll and the Liberty indexes. There's that Freedom 100 Emerging Markets ETF, ticker Freedom, FRDM. And if you look at how that ETF is built, it naturally excludes countries like China that score lower in personal and economic freedom. So they have like this freedom score that's used. I only bring that up because she actually helped pave the path here on some of these ex-China ETFs. I have to mention that, and now to see a firm like Vanguard coming in, I think is a testament to some of the work she's done.
Yeah. I mean, we will probably keep talking about it at some point, keep popping up to talk about international, but also China. But it'll be interesting to see, especially since the U.S.-China trade deal has not yet been cobbled, what kind of happens, particularly in 2025 with this sort of China ETF, ex-China ETF story, with this sort of like very big geopolitical risk in its backdrop, or as a kind of like mood setter. So let's talk mid-caps now. Your favorite topic. Okay, why do you think mid-caps are so boring? The story can't all be large or small. What, are like mid-caps literally like the middle child of
You just said equity? It so perfect. They are the middle child. Actually, I think this has been a narrative for a long time, right? Because large caps, they get all the attention, and deservedly so if you look at how they performed over the past decade. And then small caps get all this attention. And I'm not quite sure why that is. I think I was going to say,
I think small caps get attention undeservedly so, I would actually say.
Yeah, I mean, small caps have actually brought up the rear performance-wise over the past 10 years. But in all seriousness, look, I think mid-caps can offer some diversification in an equity portfolio, but I think I find them boring because over time, and this is what you were saying, they deliver exactly what you would expect, right? It's a little more return than large caps, but maybe not as much as small caps. And same thing on the risk side, maybe a little more risk than large cap, but maybe not quite as much as small cap. Like it's exactly what you think it is. And I don't know, I just find them boring.
Well, I mean, year to date, mid caps, I'm looking at the Vanguard mid cap ETF, VO. So they've just lopped off the O from VU, which is even worse, I guess, for all the middle children that are sort of listening and we're hoping to have their day in the sun. This does not feel like it. But just VO, the Vanguard Mid Cap ETF, performance so far this year is up 3%. So it is broad. It is beating VU right now, at least year to date. 1 year up about 12.5%. And I forget what I just said moments ago about how the broad market was doing. In the 1 year, I think it was more than that. So I think it's not even yet beat. This is where you see it not beat when we start to increase the tail out. 3 year, about 9%, 5 year, about 12%. Not particularly exciting stuff, but the fund flows have been exciting. I mean, in the past, I'm going to say, let's see, I'm using the fund flows tool right now. We've pulled in $123 million over the last month, about $700 million. And in the last 3 months, this is where you see a serious acceleration, $4.2 billion of inflows in the last 3 months alone to just VO.
Yeah, and the obvious, what's going on here, and we've talked about this ad nauseum, is you have investors concerned about the top heaviness of market cap weighted indices. And so if you have a concern around that concentration at the top with some of these mega cap, these tech companies, you might look further down the cap spectrum. And something that I think is interesting here, this is a little bit off the path, but some investors are looking at like equal weighted S&P 500 ETFs, like RSP, the Invesco S&P. If you look at the risk return profile of that, it actually looks a lot like mid cap stocks. So it's almost like another way to play mid caps.
Yeah,
so
there was a time where RSP was actually gaining a lot of interest from investors that were trying to move away from the sort of the tech story in their portfolio. Here's what I do actually find interesting about mid caps. Where do you draw the line for what is now a large cap to a mid cap?
Well,
yeah, I mean, because, and we have a nice article on this at ETF.com. VO holds companies in his holdings, in the fund's holdings, that other funds would consider actually large cap, and that other indices even consider large cap. So then you want to contrast that to the largest mid cap ETF, which is actually going to be IJH. That's the iShares Core S&P Mid Cap ETF. You would think the two would be sort of similar to each other in the way that SPY and VOO are similar to each other, at least in terms of performance. And that is not true. As I just mentioned, right, we have VO. What do we call VO? What should we? Is it just VO?
I'm going VO. Yeah, I'll go VO. No VO.
Right. No, just not like instead of VOO, you're like VOO. Anyway, yeah. IJH. So the performance on VO up 3%, right, year to date. IJH is down 3.5% year to date.
Well,
I mean, clear divergence.
I don't have it in front of me, but pull up like MDY, the Spider mid cap ETF, and you raise a really good point in that. If you look at the performance of these different mid-cap ETFs, they're fairly substantially different. And that gets into, obviously, the underlying index provider. And I will say, when you're asking, how do they determine what's a mid-cap? Obviously, they have very clear rules where they spell out exactly where their market cap break is between large, mid, and small. So you just have to look at that as an investor and then decide, what you want to do.
No, right. To. But what I'm saying is, it seems as if there is a difference in how they're.
There are, there's some substantial differences.
Which I don't think you have as much when you are looking at large caps or even small caps.
But it depends on where those breaks are. It depends on who the index provider is.
Yeah.
The thing with large caps is you have those companies at the top, which are driving a lot of the performance. Mm-hmm. So it doesn't really matter. I don't say it doesn't matter, but it doesn't matter as much where that break point is.
Well, MDY performance mirrors IJH, frankly, which is, again, not particularly exciting. You're in the negative right now year to date, so you're actually not beating broad market. And then when you kick out the performance for a longer time horizon.
All right, that's enough. Let's move on to a more exciting topic.
We could talk about middle children another day, another week. We're going to see.
Are you? I'm actually a middle child.
I am not. So, I'm actually the eldest. So I'm the large cap of my family.
I should sympathize with mid caps, but for whatever reason, I don't.
Do you feel like you're the large cap of your family, even though you're not, even though you're the mid cap of your siblings?
Yeah, I don't know. Not really.
I'm trying to ignite some kind of like Geraci sibling rivalry. It's not working right now.
I'm not taking that one.
You're not taking that bait? All right, fine. Okay, so let's talk about investing like Warren Buffett, for example. There is now an ETF for that. There's actually 7 ETFs for that. So Michael Burry, Warren Buffett, Druckenmiller is another one. You can now invest. I'm actually surprised this actually.
Well, let's be clear. There's filings. You can't actually invest in these yet. These are filings that are out there. Just want to be clear.
They're correct. You are absolutely correct. I do apologize. So Visa Shares is planning or hopes to launch 7 new ETFs that is going to track, these sort of top investors on Wall Street. So the names don't really tell you. Don't really tell you much. You've got like the Vista Shares Duquesne Select ETF, the Berkshire Select ETF, the Pershing Square Select ETF. Again, this is going to be after like Michael Burry, Bill Ackman, Warren Buffett. There's several top investors. Like I said, I'm surprised that this wasn't done before.
Well, okay. This has been done in a different manner. So basically what these ETFs are doing is they're looking at the 13F filings that are out there to try and mimic the holdings of these investors, the ones that you mentioned. And this has been tried. There just hasn't been a whole lot of success, at least in my opinion. And part of the reason
I should
for that,
say, actually, OMAH, right? So that's the Visa Shares Target 15 Berkshire Select Income ETF. That was already launched a couple months ago.
And I'll touch on that. What I'm talking about is you can go back years ago. Like Global X had one, it was Guru, GURU is the ticker, where the way they pitched these were like hedge fund replication ETFs, to where they would look through to the 13F filings from a variety of hedge funds. And some of them try to target certain strategies, long, short, or whatever. Some were an amalgamation of that. The problem is that the 13F filings, those are on a delay, right? So it's not the real-time moves of those investors or firms. You're looking at a historical snapshot.
Right.
And so if you just take a step back and think about this, once those holdings are disclosed in the 13F filings, well, everybody knows about them at that point. And so I think it gets into like, is there real alpha to be had here, real outperformance? So that's first point I'll make. Second point is you mentioned some of the investors involved here. So Warren Buffett, there's Stanley Druckenmiller, Bill Ackman, Michael Burry, and obviously some of these have remarkable performance track records. But I'll pick on Michael Burry a little bit, and that go look at the performance that he's had or some of the calls that he's made over the past.
I was going to say
years.
He's been wrong.
Yeah, I think he's a good example.
Quite a bit.
Of somebody who got one big call right, and they are essentially living off of that and making money off that ever since. It's like the media.
Michael Burry, if you're listening, don't come after me. Go after Nate. I don't want any smoke.
Well, I would say that if he was here, and I'd love to hear his retort to that. It's not anything personal. It's just I do think there are a lot of these. We can
invite him on. We can always invite him on.
I think there are a lot of these names in asset management who, again, they got one big call right. And once you have that, the media wants you on. They keep asking for you to offer an opinion on the markets, but nobody goes back and looks at whether you got those opinions right. They're all still hung up, like on his case in The Big Short. So I don't want to get hung up on that.
Yeah, well, you know what that actually reminds me of? That reminds me of there's some folks out there that are like the anti-Cramer, making the anti-Cramer bets, where they just, whatever Cramer says, they just do the opposite because they don't trust him.
But here's where I was heading with that. It wasn't to pick on Burry, but I think you have to get a few things here right. You have to hope that the 13F filings actually track the underlying performance of these managers very closely, which in some cases they may. Like if you have Warren Buffett, who doesn't have a lot of turnover, then it'll probably track him pretty well.
So that's what I was going to say.
But then you have to hope that the manager actually gets their call right. So I just think
is it just the timing, though, that you think that this secret sauce cannot be replicated? Because, for example, you mentioned Buffett, and Buffett might be not so much an outlier, but I mean, he does talk about buying and holding in the long term, right? Yeah. I mean, Buffett's not a trader. He never has been. He never has really sort of operated like that. He does tend to kind of buy and hold, and you hear, of course, every so often of him like offloading or onloading into his portfolio, some new holdings, but I think his portfolio has been maintained in sort of a relative consistency. So if the theory is that you are supposed to buy and hold, right, for the long term, and that's what you are essentially investing for, a regular investor, a retailer who's not necessarily looking to gain, 20x or 20 plus over, the broad market or something, right? They're not obsessed with alpha in the way that other investors are, that maybe even advisors are on behalf of their clients, but they're just like, you know what? I don't know where to start. I just want to make good, smart picks. Then
and this does seem like this S&P 500 if that's what they want to do. I would say start there, and I would say show me the data. I want to see the data that shows replicating or tracking 13F filings can outperform the S&P 500 over the long term. So somebody show me that.
I mean, honestly, Buffett would even say that that's not possible.
And by the way,
saying that.
Like, do I believe in efficient markets overall? Yeah, I do. But I'm not here, I think there certainly can be times where the market is less than efficient because you get the whole behavioral element in there. But again, once these 13F filings are public and it's out, like you're talking these algos, stuff will pick this up immediately. And I just don't know that there's a whole lot of alpha to be gained. Now, one thing I will say, just with Vista shares in particular, you mentioned their, what is the ticker? OMAH, right?
Yeah,
Omaha, it's like Omaha where Warren Buffett resides, their Target 15 Berkshire Select ETF. That launched in March.
Yes.
And if you look at its assets, already up to like 225 million, which that's pretty good. And not only that the fee, hold on, the fee on that is 95 basis points. So that's pretty good that investors are putting 225 million to that at 95 basis points. My point being, is there some appetite out there? Are there some investors that maybe do want to, track some of these investors? Of course. And I have no issue with that if you want to do that. I would just encourage them to, look at the longer term performance track record here.
This actually kind of reminds me of those, the ETFs like Nancy, NANC, like Cruise. We already know that politicians invest. They too are obligated to disclose. And there are funds that go and just try to ride whatever they are investing in. A little bit different though, because politicians are definitely closer to traders than long-term investors.
But it's still the same concept. And that information is public. That's what I'm getting at. So once those 13Fs are out in the wild, everybody can see them.
So it's
not like these ETFs are getting the 13F data before everybody else.
So if we had to give this like a Nate on a scale of like 1 to 5 Nates, what would you rate these? 3 Nates? 4 Nates? I'm starting a new ranking system, if you haven't noticed. I'm going
to give you a very political answer, but I mean it. I actually really like the like Adam Patty, the CEO over at Vista Shares, and what they're doing. They're trying to be innovative in the ETF space and trying to come at this from a little bit of a different angle. I'm a huge fan of that. And so that's what I was saying. I have no issue with these ETFs existing. And I think there are moments in time where they may outperform. I just think it's a tall task to expect these to perform over a longer period of time. And so I'm not a huge fan of them in that regard, and for all the reasons I've already talked about. I just don't know that, most investors owning this in the core of their portfolio is going to be beneficial. That's all.
I'm going to call that 3 Nates then. 3 Nates out of 5, bang in the middle.
Yeah, that's fine.
We've got pros, we've got cons.
Yeah, I think that's fair.
All right, let's talk about something that you're not going to snore at. Crypto. Your face is already lit up. So crypto staking is going to, it looks like it could potentially be tripping up, some of those crypto ETFs because they offer, they're tracking crypto staking. So we have like Rex and Osprey. They're trying to launch these ETFs that track staking and tracking, that track Ethereum and Solana, that offer staking exposure as a backdrop. The SEC has now said they're not even sure that this qualifies as an ETF and that this sort of the filing is incorrect because they don't actually fit the definition of an ETF. What are your thoughts there? Because this was supposed to be a very crypto-friendly SEC. And this doesn't mean that they're not, but they are raising this question about sort of crypto staking and sort of tracking, these cryptos that offer that staking exposure.
I'm trying to think about how to describe this without getting too far into the weeds, because the way that I view this, it really isn't staking specific per se.
Mm-hmm.
Basically, the structure that Rex and Osprey are using to bring these ETFs to market is different than the structure that is used for spot Bitcoin and spot Ether ETFs. Mm-hmm. You have 33 Act versus 40 Act funds. And because it's a different structure, the approval process that these Rex Osprey ETFs have to go through is different. So essentially, Rex and Osprey, they didn't need to have an exchange like NYSE or NASDAQ get a rule change approved to have these trades. So instead, they were just hoping that these ETFs would go through the normal ETF approval process. So just think of like,
got it.
If you have like a S&P 500 ETF or whatever, just something normal under the ETF rule, goes through the normal approval process. And basically what the SEC said was, hey, hold on, not so fast, that maybe they couldn't use that structure in these two cases. And it gets into, again, we get into the weeds. They have a Cayman subsidiary. That's actually the one who is holding the spot SOL or spot ETH and doing the staking. But the fund itself is a 40 Act fund versus, the 33 Act funds like you see with spot ETH or ETFs. It gets into the weeds. I don't think, here's my take. I don't think the SEC is necessarily as concerned with staking as just saying, we don't think this is the right structure to do this in. And I mentioned back in January of this year, once we had the change in administration, that ETF issuers were going to try to do whatever they could to push the envelope with the SEC and essentially test the boundaries to see what they can get. This
is a sign of an example.
Yeah, I just think they're doing this to see what they can get away with, and I don't mean that in a nefarious way. They're just saying, hey, here's an innovative structure. ETF issuers are really good about thinking outside the box, and keep in mind, first mover is such a huge advantage in the ETF space that if Rex Osprey was able to get this to market before anybody else, even though the structure isn't ideal because it's a C corp, there's double taxation. Again, this gets really far into the weeds for I think our purposes. But the point is, I would say it's not the most efficient structure to bring spot SOL, spot ETH, and then do staking in both. However, if you're first to market and maybe your competitors don't come along for 3 months or 6 months or whatever, that gives you an advantage, and you can get some assets into the fund and get your brand out there. So I understand why they're trying to do it. They're not trying to do anything nefarious here, but I think the SEC is pushing back. And I think what it gets into, if I were the SEC, I'm on record, Kristin, as saying, I think spot SOLs or ETFs are going to be approved before the end of the year. I think staking in both is going to be allowed before the end of the year. So if you're the SEC and you know that that's the optimal structure, is that 33 Act, then they may be saying we're not going to approve these Rex Osprey ones. It's the wrong structure, whatever. And they'll ultimately approve the better structure later this year, if that makes sense.
Yeah. I wonder, though, if this goes the way of, I doubt it, though. I remember when we were talking about that State Street, the private credit fund,
right.
It was approved, it listed. And then later the SEC was like,
well, that's a good example, actually, because
then the SEC later was issued criticism about it. And I was like, why didn't you do this before you had approval for it?
No, I mean, actually, it's a good example or, good analogy here, because this particular filing or these filings for the Rex Osprey ETFs, they did go effective. But then it came out that there had been quite a bit of back and forth between them and the SEC over the last several months. And the SEC clearly didn't feel like all of their concerns were addressed up to this point. But that gets into what I was saying earlier. And I think I said the same thing with private asset ETFs. Issuers are just going to look to test the boundaries. You have a new, theoretically more lenient SEC, I guess you could say, right? They're not, at least that's the perception. The Trump administration is trying to lessen the regulatory burden.
There's only one Democrat right now, and who is definitely more anti-crypto or anti-digital assets than her Republican counterparts.
Which, by the way, I have to mention this. Did you see the statement that she had? I've got to read this to you.
Yeah, how is it that these crypto assets are supposedly not securities when it comes to registration requirements, but conveniently are securities when a registrant sees an opportunity to sell a new product? If you're confused, join the club.
It was the last part that I liked. If you're confused, join the club. Take a little shot. That was SEC Commissioner Crenshaw. I just thought that was funny. But yeah, to your point, I mean, she's always taken a I would say, anti-crypto stance. So yeah, look, to summarize this, I don't read anything into this about the longer term prospects for spot SOL ETFs or staking being allowed in either ETH or SOL ETFs. I think that will all still happen. I still think a really good chance by the end of this year. And, in the meantime, again, you're going to continue to see ETF issuers be creative. And it's not just going to be in crypto. It'll be in private assets and other areas. They're going to push the SEC to see what they can get away with.
Yeah, I definitely agree there. I think the question will now be, what does the SEC let slide that they probably shouldn't? And what will we be talking about later? Especially in the crypto arena. But we'll be here and chatting about that in the next couple of months and possibly years, who knows? Or our AI versions will be doing it for us. But that's it for this week's episode of ETF Pulse. Next week, Nate and I will be doing the episode from Boca Raton. How do you say it? I just say Boca
Raton. Boca Raton.
You just made it so boring. Anyway, Boca. Nate and I will be in Boca, and we'll be taping our ETF Pulse episode there as we both go to the Wealth Management Edge conference. So maybe we'll have some insights from the conference that we can share, especially from our panels.
I hope so.
I don't know what panel you're on, Nate, but I'm going to be talking fixed income. I know
I'm going to be doing, I have like a roundtable discussion around ETF education.
We can talk them both. Both.
Yeah, I love it.
Yeah. Awesome. All right. Well, we will see you guys next week. Thanks so much, Nate.